This video will help you understand how an exchange fund works in the event you have a lot of concentrated stock. If you don't know who I am, my name is Chris Dime. I'm a financial planner out of Edmonds, Washington, and I specialize in working with folks to and through retirement. With the rise of stock-based compensation plans over the past couple of decades, combined with living in the kind of greater Seattle area where there's a ton of technology stock compensation, namely, you meet a lot of folks that have quite a bit of their overall net worth tied up in maybe one or two concentrated stock positions. This can be a challenge for a number of folks who want to diversify out of said concentrated stock, but realize in doing so, there's going to be a tremendous amount of taxable capital gains that will occur in the event they try to sell off bits and pieces at a time. Now, while that might actually be the best strategy, there might be some other strategies to think about employing, namely by the way of using an exchange fund. So in today's video, we'll talk about who's eligible to use an exchange fund, why you would even consider it in the first place, and then ultimately how to get your money back out of one if you get yourself into one. So let's jump in. Now, to be super clear, exchange funds are totally different from exchange traded funds, or ETFs for short. ETFs are those publicly available, super well diversified funds that I think the minimum investment for those is like $1. They're found online at any major retail investment custodian, Fidelity, Vanguard, whatever. And you don't have to meet any sort of like major qualifications to start investing in ETFs, other than having $1 of disposable investment capital, I suppose. Exchange funds, on the other hand, are totally different, even though they're kind of a homonym for ETFs. At a high level, exchange funds allow one with a large portion of concentrated stock to exchange their 100% ownership of said concentrated stock for partial ownership of a fund that conglomerates multiple different forms of concentrated stock. And it does all this without recognizing capital gains for the investor. That said, in order to get this preferential tax treatment where you exchange a very concentrated position for a far more diversified position, there are some special rules to follow, and so we'll jump into those now. Let's start with first, who is allowed to fund one of these? Unfortunately, in contrast to securities and things you can invest into on, we'll call it the retail side or the open-end side, there are some qualifications to meet. Number one, you have to have a large portion of concentrated stock. Generally, I see minimums out there of around 500 grand to $1 million in order to fund an exchange fund, or at least to be part of the fund. But there are some investment companies that offer exchange funds for around 100 grand or a little bit more than that. So first and foremost, you must have a large portion of concentrated stock. Secondly, you must also be considered what the SEC defines as an accredited investor. Now, this is actually a specific definition. It's not a colloquial term just thrown around out there. And essentially, you have to meet one of these two qualifications. You either have to be a single taxpayer who makes 200 grand or more, or you have to be a married couple filing jointly that makes 300 grand or more, and you have to have made that income for at least the past 2 years. If you don't meet those income thresholds, you at least must have a net worth of over $1 million, not to include the equity in your primary residence. Okay, so let's fast forward and say you are an accredited investor and you have $1 million of concentrated company stock. And let's say you're entertaining the idea of getting into an exchange fund. Let's talk about how they work. As we touched on earlier, you're allowed to exchange your ownership of this concentrated stock for a shared ownership in a much larger pie of other concentrated stock positions. For like an example, let's say you had $1 million of Microsoft stock, you could join an exchange fund with 4 other investors who might have $1 million of Amazon, Google, Netflix, and then Apple stock. And in essence, now you go from having 1 million of Microsoft stock to 200 of Microsoft, 200 of Amazon, Netflix, Google, and Apple in this example. Now, you could argue that maybe diversifying Microsoft for other massive tech companies might not be the most diversified of exchange funds, but philosophically, I hope you understand that the point is to exchange your ownership for a partial ownership in a larger fund. I suppose you could analogize it to like a Thanksgiving dinner where everybody brings 100% of a particular dish, right? Some people bring stuffing, some people bring mashed potatoes, whatever. And in exchange for bringing your 100% of something, you now get to share proportionally in the gigantic Thanksgiving feast that the fund company is preparing for everybody. And overall, it's a pretty good trade. Unless you bring the investment security equivalent of green bean casserole, which at that case, you probably just shouldn't be invited into the fund. Now, normally, if you transfer a concentrated stock position to someone else, and in exchange for that, you get a well-diversified stock position. Normally that would come with recognizing what are called capital gains, and then taxes would ensue. And for those of you in Washington state, you'd probably also get hit with the Washington state capital gains tax. I'll link above here for an explainer video on that. But ultimately with an exchange fund, the value is that you do not have to recognize any of these capital gains, even though fundamentally you're changing your concentrated position to a very well diversified position. Now, in order to qualify for this tax treatment, the fund must have, I think it's like 20% of the overall balance invested in illiquid securities, which a lot of times funds will just use like real estate, for example, for exposure there. And the money contributed to the fund must stay for at least 7 years. And of course, if you violate any one of these two precepts, you're going to get hit with capital gains taxes. There might be some early withdrawal penalty fees from the fund, etc. So generally, you should plan on locking this money up for at least 7 years. But if you're concerned about, the volatility with your concentrated stock position over the next couple of years, the math can make a lot of sense that you would move it into a fund that's illiquid, but a little bit more diversified. And speaking of taxes, for those of you who might be concerned, your cost basis doesn't change. So if your cost basis was 100 grand in this $1 million of Microsoft stock, whatever you exchange into the fund at and get a diversified share of, you still maintain 100 grand of basis throughout all of the different positions. So there's no rise in cost basis just because you're using an exchange fund. Your basis stays the same. But like any other investment, your gains portion might change. And ideally, if the fund performs well, while your basis would stay the same, your gains would continue to grow. But those gains would be tax deferred and you wouldn't have to recognize anything. And there's some other ancillary benefits that come along with these types of funds that might be attractive to the particular demographic of person who has $1 million of concentrated stock. Namely, the exchange fund is exempt from registration. So it's allowed to play outside the lines of a lot of SEC requirements. The technical term for this would be like a private placement, and it essentially avoids like public disclosure if you're trying to keep what you're doing with your finances a little bit more private. In addition, for those of you who are executives, directors, or you own more than 10% of a particular public company, you are allowed to avoid filing Form 144, which essentially just means you have to tell everybody what you're doing with your money. In a situation like this, using an exchange fund, you don't have to make that totally public. Now, unique to what could be contributed into the fund are a couple of examples. The most popular one, though, that's not unique is publicly available stock. Like I mentioned before, if you had $1 million of Microsoft stock, you could totally find an exchange fund that would gobble that up, no problem. And you could tag along for the ride of at least that 7-year illiquidity period, et cetera, et cetera. But there's a couple of other things you could also put into the fund as well. Now, we've already touched on, maybe controlled securities or things that otherwise you'd have to alert the SEC if you're going to be doing some trades on. So that's attractive that, you could put money into these types of funds that otherwise would have a bunch of rules and regulations attached to them. In addition, if you have restricted stock, you are also allowed to put that into an exchange fund, depending on the fund's rules and regulations. Some funds will allow it, some funds won't, and some funds would give you like a discounted value for contributing shares that may or may not be as liquid as just a straight up Microsoft stock. Keep in mind though, even if you have $3 million of Microsoft stock, the fund is allowed to reject you wanting to be a part of it because maybe they've already reached capacity with that particular security, or for whatever other reason, you contributing to this fund doesn't add to the overall diversification, which all the other investors are trying to achieve. So let's fast forward 7 years and say now you're ready to exit this exchange fund and you want to take your money back. Well, there's two ways to do that. Number one, you could either sell everything and take it as cash. And while generally that's probably not going to be the most advisable strategy because the whole reason you did this was so that you didn't have to recognize capital gains, for one reason or another, it might now become a more appropriate time to recognize those capital gains in all, or maybe at least in part. So moving to cash generally probably wouldn't be the smartest move, but I could definitely see some cases where it would make more sense than others. The other main way to exit the fund is just to account transfer out the positions you now are partial owner of. And you would no longer be a partial owner at that point, you would be 100% owner of your portion of those particular securities. So in the aforementioned example where you came in with $1 million of Microsoft stock, you would then exit with whatever that $1 million appreciated to, but divvied up among various other shares, Microsoft, Apple, whatever. Again though, your basis doesn't change. The only change would have been by way of gains that have occurred within your ownership of these positions. And I suppose there is also a third way you could exit the fund is if you exited the earth. If you pass away, just like any other non-retirement investment account, you would achieve what's called a step up in basis. And for example, let's say your ownership was still $1 million for whatever reason, you still only had $1 million of value inside this exchange fund. You would go from having that previously mentioned 100 grand a basis with a total value of $1 million to passing on to your heirs a stepped up $1 million position made up of those 5 different stocks. 200 grand, 200 grand, 200 grand, 200 grand, 200 grand. Okay, so what does it cost to have money inside of one of these exchange funds? Well, there's probably going to be some level of initiation fee or onboarding fee, etc., nickel and dime nuisance fees, whatever. Philosophically, though, there's generally that 1% per year management fee. While some people might not find this very attractive, others who are looking for diversification might put a bigger value on that 1% than maybe somebody else. Because nothing's really changing within the portfolio by way of ownership. It's not like the fund manager can sell out of everybody's stock positions and go buy bonds, because the whole purpose of the exchange fund is you come in with what you got, and then the fund stays invested in those items. So I would argue it's more of like an administrative, tax or administrative fee rather than some, whiz-bang portfolio manager fee. But there's a lot of compliance and regulations that goes into this, so I could see a case where someone might charge 1% and the math makes sense for both parties involved. And then you might be thinking, okay, what are some vendors who do this? Or otherwise called investment custodians. Now, technically these have been around since like the 1930s, but I think they really started to gather steam right around the mid-70s, because that's the time when Eaton Vance, one of the fund companies that still offers exchange funds, won an IRS private letter ruling, essentially affirmation by the IRS that these are totally legit, whereby you could transfer money in, get exchanged for different ownership in different stocks, but avoid constructive receipt, which is the technical term for when you owe capital gains taxes. Now, Eaton Vance rolls up underneath Morgan Stanley, so that's probably the avenue you'd want to go if you want to work with those folks. But there's other vendors out there, of course, that offer these types of exchange funds. And so, of course, like anything in the investment space, you're going to want to do your due diligence. And as opposed to using a super common retail investment platform, there's actually going to be a lot of differences with each exchange fund. So it's a lot of extra work you'll have to do if you want to get into one of these. So from a calls to action standpoint, if you are currently sitting on or expect to eventually be sitting on a very large concentrated stock position, you'd like to have more diversification and you'd like to achieve that diversification without paying capital gains taxes, you might want to look into getting involved in an exchange fund. Either enlist your advisor to help you find one of these or have them refer you to someone that specializes in finding exchange funds. But as these are highly complex and advanced securities, just know that there's a lot more risk that could happen with these types of funds than investing in your classic index funds at any sort of like retail investment company. Now, as a general rule, I'm not a huge fan of maintaining super concentrated stock positions. I'm a big fan of being super well diversified using index funds and paying capital gains taxes. I don't like paying taxes, but I like diversification more. But of course, there are some case studies where these types of funds can make a lot of sense, which is why they are offered. And of course, as you can imagine, they're probably not a good fit for the vast majority of folks out there. But for a small segment of folks that would benefit most from the tax provisions, it's totally something to be aware of. So hopefully that was helpful. If you have further questions, drop me in the comments below or get in touch with the website. We'll help you get squared away. Have an awesome rest of your day, and we'll talk to you later. Bye.